Dealer doesn't want you to know this part. Oil price drop, watch gold price. Dealers have their own agenda, and in this video, I'm going to pull back the curtain to show you one of the many things they don't want you to know. I'm going to break this down and show you how to get ahead of this precious metals market without being fooled by the person profiting off your ignorance. Let's start with Reuters. This article is headed, Oil Prices Set for Steepest Weekly Drop in 3 Months. That's painful. It begins, oil prices steadied on Friday after weaker than expected U.S. jobs data. We'll get to that in a minute. But kept on course for their steepest weekly loss in 3 months. Now, this was weighed by concerns about demand and high interest rates. Brent crude futures for July were up 17 cents or 0.2% to $83.84 a barrel. And let me explain to you what this means for gold, because dealers don't get into this. They just smile at you and tell you the spot price and tell you what a wonderful investment gold is. That's how they make their living. They're selling this gold that is now presently about, with a premium, you're looking at close to $2,400 for this 1 ounce of gold. That's a heavy price. Now, this is what we really need to know for us as stackers, as the customer, as the consumer. There's a silver to gold ratio. We've heard that, right? This silver that I'm holding here, there's a silver to gold ratio. So presently, what is it? I'm off the top of my head, it's about 85, 86 ounces of this silver is equivalent to 1 ounce of gold. So one method of stacking silver and stacking gold is to accumulate as many ounces of silver as you can. And then as that ratio tightens, as it gets lower, preferably closer to 70 to 1, or even lower than that, ideally 50 to 1, right? Then we swap out our silver for gold. That's following the silver to gold ratio. Now, this is an article from Oxford Gold Group, and it says, how do oil prices and gold prices relate? We don't talk about this much, but it's really important. It says oil and gold prices tend toward a positive correlation. You could see this when viewing gold and oil's time-based price charts, which anybody could pull up, with both commodities reacting similar to the same type of economic pressure. For example, each of these assets' price levels will respond to changes in the US dollar. They will respond to inflation or interest rates by moving in the same direction. However, in commodities, as in everything else, a correlation does not constitute causation. So just as silver typically lags from gold, it's not like silver is causing gold in any way to move up. There's not a causation like that. Now, the article continues, oil does not necessarily determine the gold price. However, because they move together, oil can give you some helpful insight into the direction in which your gold investment is going to move. I know that word investment scares us as silver stackers and gold stackers, but I'm just using it for educational purposes. Oil prices tend to be more volatile when responding to immediate supply and demand concerns, but while gold may also have a finite supply, its relative stability means that any pricing adjustments are slower to respond to these same market pressures. So it moves for the same reasons oil moves, gold will move. So if you see oil moving, we won't see gold move immediately, but it eventually will have the same correlation. And that's the important part that we tend to forget. So gold typically provides more trading stability and security, giving its larger and more confirmed inventory levels. Now, this is where this article explains the gold to oil price ratio, and they explain it better than I do. It says, the gold to oil ratio is an investor's calculation tool to outline the comparative value between these two assets at any time. And the article says, with this financial mechanism, you could easily calculate the current pricing difference between an ounce of gold and a barrel of oil. You could then use the ratio to determine whether or not you would gain more purchasing power by investing in gold, right? These are topics and conversations that your local coin shop dealer, unless he's very informed, I say he because it's typically a man, unless he's very informed or you grill him on it and you start pulling this information. So we often hear about silver to gold ratio, but we rarely hear about gold to oil ratio. If you're enjoying this video, please hit like, hit subscribe. It really means a lot. I always forget to say that. Please hit those buttons. It really means a lot to get this information out there. It helps a lot. Now, speculators will use this type of ratio to identify excessive pricing, which is a potential opportunity to fill the market's pricing gaps for profit. The idea is to buy into the lower priced asset, of course, to improve your odds of higher returns. I'll say that again. The idea is to buy into the lower priced asset to improve your odds of high returns. So just as we look at that silver to gold ratio, this is another ratio that we as silver stackers, gold stackers, or even if you're an aspiring gold stacker, because gold is so out of reach, very far out of reach for everyone. I completely understand if you are only into silver right now, and I am presently. I'm not buying any gold right now. I'm only into silver. But this really opened my mind, this gold to silver ratio, gold to oil ratio. And it's, again, something that silver dealers, gold dealers, your local coin shop, they don't see themselves, they don't see their role as an educator. They see their role as a businessman. They're running a business. So they're not necessarily being sneaky and hiding things from you, but it's a topic that's not often spoken about, and it's clearly very important.